I'm Destin Morrison. Welcome to my channel. For those of you who don't know me, I've been trading for almost a decade now. I'm a full-time day trader, and I want to share with you in today's video a few reasons why I chose Forex over other types of markets and why I think it's probably one of the best choices that I've made in regards to anything financial. A few reasons why I got started in Forex specifically. One, it's a 24-hour market. So 5 days a week, there's someone somewhere always trading. So it's always available, regardless of what your schedule is. If you're working first, second, third shift, you have an opportunity to make money in the markets. It's got high liquidity. Startup cost is pretty low. You don't have to have a lot of money to day trade. There's a myth that you have to have tens of thousands of dollars in order to be successful in trading. But if you've got 50 bucks to your name, you got $10 to your name, you can technically trade. There are brokers who allow you to trade for just $10. I personally wouldn't recommend that, but that's just to give you an example. You don't need a lot of money to make money trading. All right. And it's accessible. I'm able to travel across the world. I left the US earlier this year to become a full-time day trader, and I now live in Northern Africa. And if you have an internet access and you got a phone, you can trade from anywhere in the world. So that allows me to be mobile and to do more things that I enjoy while still having access, right? I don't have to be stuck in a cubicle all day. Potential for profit, the amount, a lot of people love to ask me, how much money can you make in trading? The technically, you can make as much money as you want. There is no ceiling to how much money you can make in trading. It's really just about uh, your understanding of the markets, how much capital you have to trade, and how consistent you are. If you learn the right habits in the beginning, and my goal in this video is to give you the fundamentals of trading so you have a good framework to work with, and you can kind of take these things and build from it. But if you learn the right principles in the beginning, you are going to set yourself up for success versus going through all these different online courses and these different channels that give you tons of information overload. I want to simplify this for you so that way you can digest it, you can do something with it, and then you can come back if you've got questions or anything, post them in the comments below. But I want to give you something that you can work with. All right, and it's a global market. So it's influenced by a wide range of factors, economic reports, news events, political changes. But I wouldn't get so caught up in just the fundamentals because you have different types of traders. So you have fundamental traders, they're focused more on the economic events that happen in the world. And you have technical traders that focus more on chart work, right? Like what are candlesticks, how they move when they reach certain levels, things like that. So don't let the economics of it overwhelm you because it's very easy to get so caught up in that to where you get analysis paralysis. And that's just basically where you have too much information, you don't know what to do with it. All right, so we're going to keep it very, very simple. So what exactly is Forex? If you've ever traveled somewhere, let's say you go to London, for example. I'm on London time right now. So if you exchange your dollar for theirs, that's basically what Forex is. The only difference is we do it online and we trade to make money. So it stands for the foreign exchange market. It's basically like just swapping your dollars for euros. Um, let's see here. Whenever you're going to actually participate, when you're actually placing a trade, what is it that you're doing? So for this example, we're going to use the Great British Pound Sterling versus the US dollar. All right. So when you're buying one currency pair, let's say you're buying the pound and you're selling the dollar simultaneously. So if I sell the pound, I'm buying the dollar. All right. So you're going to buy a currency. Basically, if you think the value of it is going to go up. So if I think that the British pound, the value of this dollar is going to increase over the next day, the next, let's say 10 minutes, 1 hour, 4 hour, and I place a buy order, then I'm basically betting against the US dollar. I'm betting that this value is going to increase and this value is going to decrease in comparison. All right. So I'm pretty sure if you've heard anything in the markets, you've heard you want to buy low, sell high, right? That's the idea. Everybody wants to find the perfect entry point so they can make as much money as possible. And we'll get deeper into that in later videos as far as strategy, but I just want to give you an understanding of what it is that we're doing here. All right, so a few basic terms you're going to want to know. Currency pair, we spoke about that. The British pound versus the US dollar. That is the currency pair. So you have a lot of different other options. We're going to stick with the pound dollar. But for now, I just want to show you a few other examples. So you have the Great British Pound Dollar, you have the Euro, USD, you have Euro JPY, so that's the Japanese yen. You have the Australian dollar, the Aussie. You have the New Zealand dollar. So there's tons and tons of different types of pairs that you can trade. You have major pairs, which are the ones that are most heavily traded, and then you have what's called exotic pairs. So these are pairs that you're not going to hear about as often, such as like the ZAR, for example. Now, so that's just something to keep in mind. Pips. So if you ever hear a trader speak about, yeah, I made 10, 20, 30 pips today, this is what they're referring to. So as you can see over here, this is the price. Right now, the price is $1, $127,969. So the difference between here and here, this is the amount of pips. So let's say it moves up 40 pips and it reaches this level here. If you were to buy, let's say you bought this price for 1 cent and it moves up 40 pips, you've made 40 cents. So if it moves against you 40 pips, you've lost 40 cents if you bought. Now, on the flip side of that, if you were to take a sell order here for 1 cent and it goes against you 40 cents, or it goes in your favor 40 cents, then you make money. So you can make money on either sides of the market. It's really just about how you position yourself, timing, and proper risk management, which we'll cover that in later videos as well. But just an overview of that, your lot size, that 1 cent that I just mentioned, that's what you call lot size. So think about that like the number of apples that you're buying. All right. And then we have leverage. So one of the cool things about leverage, and this is what I like about Forex in comparison to other markets, it gives you the ability to trade larger sums of capital without having access to that much capital. All right, so imagine borrowing money to trade more than what you actually have. So it's like, think about it like getting a loan for a house. Let's say you want to buy a house that costs $100,000, but you only have $10,000. So you go to the bank, you ask for that loan for 90K. Now it's just your $10,000 that you have access to, or that you actually have. But now that you get this loan, you can actually purchase a home that's $100,000. So Forex leverage works the same way. So if you want to take a big trade and you don't have enough money, you can borrow extra money from your broker. All right, so just like with the house, it lets you control something much larger with what you wouldn't be able to afford on your own. And that gives you way more access, and it changes the playing field, because now you can, if you use it properly, you can scale up an account pretty quickly. And the only thing is with leverage, and this is what gets most traders, is that it's a double-edged sword. So you can make money, you can make a lot more money, but you can lose it quicker as well if you abuse leverage. So if you're doing a 10 to 1, for example, That means you get access to $10 for every $1 of capital you bring to the table. All right, so why do most people choose to trade Forex? It's got a low barrier to entry. You don't have to go to school for it. You don't have to, you don't have to have a lot of experience or anything to actually get involved in trading. So that's one reason I believe most people get started with trading. But I think it's important if you're watching this and you start watching my channel, I speak a lot about risk management and having the right mindset and um, having realistic expectations. If you are trading to get rich tomorrow, don't even subscribe to my channel because I want to actually help the average person who wants to learn how they can make an extra $500 to $1,000 per week trading part-time, or if you want to go full-time, you can make even more. But my goal is to actually help you get there, give you practical steps. And I'm not here to flash some lifestyle. I'm here to teach you exactly what you need to do in order to become profitable. Let's see. So the most important thing when you're first getting started is you want to learn the basics. You want to understand exactly what it is that you're buying and what you're selling. You want to know why you're buying or selling it. And you want to know if you're doing it during the right session of the day. So the market moves all day long because different countries open business in different times of the day. So if I'm trading a pair, if I'm trading a US pair, but I'm not trading it during the US market. I'm trading it during the Tokyo market. It's not going to move as fluid and as much as it will during the US market if I trade it during a different market, because at that time, the market's closing in the US for the stock market. So these are things that you want to keep in mind. When you're trading a pair, you're going to want to trade it when the two markets overlap. So for example, if I'm trading GBP USD, for example, I'm going to want to trade it while the London market is open and the New York market is open, because that's where you're going to get the most movement, right? You want to have a you want to have a growth mindset when it comes to this. I think a lot of traders end up quitting because they think it's some get rich quick. They don't take it seriously enough, and they don't have that growth mindset that says, I need to learn. I need to continuously learn. I need to continuously build on what I learned the day before, right? So if you are going to come in and you just want to learn one thing, and I'm not saying there's anything wrong with, like, mastery is important, but you want to have as many tools as you can in your toolbox, right? Because the reason why the institutions, the governments, and these big players make as much as they do is because they have more tools in their toolbox, right? So the more you know, the better. So we'll jump in and we'll do a little bit of chart work here. I'll show you how I set up my charts. But it's just important to understand. I want to really bring this in. When you are trading with real capital, it is going to be a lot different from trading in a demo account. So if you're just getting started, I do recommend starting a demo account just so you can get used to how the market moves, what it's like to place a trade, and just get the very fundamentals out of the way. But when you're trading your actual capital, risk is very, 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 very important. If you don't learn anything else from me, the risk is the most important thing that you can have in your tool bag because it will keep you in the game longer. So I see a lot of traders, they fall into the trap of over risking, using too much leverage because they want to get rich overnight, and they end up blowing their account. They refund it, and they repeat the process over and over and over and over for years, all because they didn't understand the importance of risk management. If you can stay in the game longer, you're going to have a much higher percentage and a much better success rate than someone who makes a lot of money in a day and then they lose it and they have to keep starting over. It's all about playing the long game and compounding. So in later videos, I'm going to teach you guys more strategies, and I'm going to show you exactly how you can actually compound your account and do it responsibly. All right, so right here we have the British pound USD. Oh, cool fact, fun fact, actually. The pound dollar is actually called cable. So you hear a lot of traders refer to it as the cable. And the reason why is because that's a term that originated from the transatlantic telegraph cable. And this used to connect the UK to the US for trading. So that's something that's stuck and still called the cable today. And it's one of the oldest currencies that's still in use. It is the oldest currency that's still in use. So that's your fun fact for today. All right, so first thing we're going to do, we're going to jump on the charts. I like to keep my charts very, very simple. You'll notice that some traders will overcomplicate it. They'll put all these different indicators up because they think it's just going to make them a better trader. I'm a naked day trader, which basically means I read these candlesticks. These are called candlesticks. I read these and I don't use a lot of technology and a lot of other indicators to base my decision off of. And the reason why is because those indicators are lagging. So you're getting late information. There's no better real-time data than what you see in real time, right? So right here, this represents daily. So that means that each one of these candlesticks represents one day in the market. That's why you see it goes back to October 2023, all the way to the present date. So I'm going to drop down into my time frame after I finish marking this chart up. So I like to start from the bottom and connect as many wicks, which are basically just the bottom parts of the candlestick, that I possibly can. And then I do the same thing at the top. And I'm going to do one more to connect the closest wicks. Because as you can see, we started trending down. We had a touch down here. And then we started trending back up towards this high. So if you've ever played ping pong, or a pinball rather, that's basically what you're looking at here. Price is bouncing off of the nearest level, and it's not exact. So I don't want you to take this for face value that it's always going to bounce. But these are the areas where it's most likely to bounce. So that's just something to keep in mind when you're starting to mark up your charts. So your support level at the bottom, as I mentioned before, you want to collect as many wicks that you possibly can. It's a bit subjective, so your support line may be closer here, maybe down here. So it's not an exact address. It's about the area. All right. So we just want it to be in a certain region. So we know that, hey, when price reaches this area, something important might happen. All right. So we're going to jump down to the smaller time frame. That's the daily. We're going to jump down to the 4-hour. And we'll get exactly into the makeup of a candlestick. But right now, I just want to show you how I mark up my chart so that way it's easier to identify when trends are happening and when trends are changing. All right, so that's one form. These are one form of support and resistance. You have diagonal support resistance, and you have horizontal. So horizontal, I basically just want to collect all of the floor and ceiling levels that I can. So this is like a floor, right? We came down here, we bounced once, twice, 3, 4 times, but price never closed below this area. So I can quickly identify, okay, this is an important level. And the reason why this matters is because price is a repetitive creature. So it likes to repeat itself in the future based on things that happened in the past. All right, so we're going to try to mark up the areas where we see price had a hard time breaking past. It did break through here once, and then as you can see, once it broke, it became easier to break it in the future. But the reason why I still put my support and resistance levels here is because this just lets me know that, hey, something is going to happen once price gets to this area. It may or may not reverse exactly here. It may break through it, but at least I know that this is an important area. This is the traffic area. I just want to know where my important traffic areas. All right, so I'm going to leave it there. We're going to dive in a little bit deeper. See, price was trending here. See how we have multiple touches. So I'm mostly looking at the levels. What happens when price reaches this level? What happens when price reaches this level? All right, so let me take that off so we don't have too much clutter on the chart. I just want to give you an idea of what I'm paying attention to whenever we're looking at price move. All right, so let's go a little bit deeper into exactly what these candlesticks are. You have two types of candlesticks. You have what we call a bullish candlestick, which is basically where buyers came into the market and they pushed price up. And then you have what we call a bearish candlestick. This is where bears or sellers came into the market and pushed price down. All right, so if we get a little bit closer. So a buyer's candlestick or bullish candlestick, it opens at the bottom and it closes at the top. All right, and then you can see this bullish candlestick here, this other green candlestick, has what we call a wick at the very bottom and at the top. So what that wick represents is how far down the sellers attempted to push price. That's what created this wick. So price opened here. At some point, the sellers came in and tried to push price down to this level. They failed to do so. The buyers at some point pushed price up to this level. They failed to close up here, and then the buyers and the sellers both agreed before that time frame ended that this was the fair price. So this is where price closed. So when the next candlestick opened, because this was a bullish candlestick, it opened at the top. This is a seller's or a bearish candlestick. So the bearish candlestick opens at the top and it closes at the bottom, because when you're selling something, you're trying to push the price down, right? So you're selling it, you're trying to win this battle. So I want you to think about, like, if you ever played basketball, you got two different teams. All right, so you got the Great British Pound versus the United States dollar. So whenever the pound is winning, whenever they score a point, they're pushing price higher. Whenever the US dollar is scoring a point, they're pushing price lower. Over time, you notice whenever price is trending upward, that's when the pound is gaining value. That's when the pound is getting stronger. So over here, if you look back, you can see every time price moved higher, they pushed price higher. The US dollar tried to push price back down. And they're winning, right? They're winning. We're in an upward trend. And then finally, we got here to this level of this price, 1.30315. And then that's when the sellers came in and started to gain traction, and they started to take over the market. So the interesting thing about a candlestick is buyers and sellers can both win on the same candlestick because most candles have wicks. So that means, for example, this candlestick right here, I'll try to make it a little bit bigger for you. So this candlestick right here, if I were to take a buy here and you took a sell at the same candlestick, we both could have made money on this trade. Because at some point, the sellers were in control. And then at some point, the buyers were in control. So you can make money on either side of the market. It just depends on what your strategy is and if it makes sense for you to be in a certain type of trade based on what your strategy says you should or shouldn't do. And in later videos, I'll give you guys examples of how you can put your strategy together, how you can actually start mapping out price and figuring out exactly what works best for you. Overall, most traders usually fall into one or two categories. Some traders do both. I personally like to do both. Um, you'll hear scalping and swing trading. So when you're scalping, that's basically where you're taking very, very short trades. This could be anything from a minute to an hour to 4 hours, but you're taking short-term trades, all right? And then swing traders tend to take day trades longer. They might hold a trade for a week or a month or weeks, right? So you have to figure out what type of person you are, what type of patience you have. Some traders like to get in and out, so their capital isn't tied up throughout the whole day, or they're not stuck staring at the charts all day. And then you have some traders that are a little bit more conservative. They don't mind risking less and holding it for a longer period of time and letting it accumulate over time. So these are just some things to think about. And you're looking at the charts, there's a lot of different ways that you can capitalize on the movement that's happening. But you just have to understand what your personality type is and what type of strategy you're going to stick to. All right. And then lastly, we'll just cover what a trend is. I don't want to give you guys too much information on the first video, but a trend is basically where price is either creating higher highs and higher lows, or lower highs and lower lows. So right here we have what's called an uptrend. So from here to here, we have an uptrend. So we have a high, we have a higher high. So for the sake of the video, I'm just going to start using abbreviations. So this would be considered a higher low in comparison to this low. That's not the best example of a low. Matter of fact, here's what I'll do to make it a little bit easier for you to understand. So let's just say this is our first low. This is our first low. This low is higher than this low. So it's a higher low. This high is higher than the previous high. So this is a higher high. So uptrend is made up of higher highs and higher lows. So right here we have, that's right, a higher high, and we have another higher low. So with that being said, a downtrend is basically the opposite. As you can see right here, if we were to draw a line right here, you can see how the trend stops here. And once this happens, we have our first lower low. And here we have a lower high. If this is your first lower low, and this would be just a low. All right. So you have a lower high, lower low, lower high, lower low, and so forth. So what you can do today, after this video ends, you can go pull up, if you're not doing it already, you can go to Trader's Way or Trader's View right here, and you can open up a chart. It's free to join, and you can practice this. Find the chart and see where it's trending and see if you can identify where the highs and the lows are. Higher high, higher low, higher high, higher low. And then see where the market changes. Boom. This is our important change here. This is where everything changes. This is where we create our first low. So this was lower than the previous low. This was lower than that previous low, so forth. So you want to practice this and get really good at it. The more and more you do it, the quicker you'll be able to identify it when you see it on the chart. And once you really master this, that's when you start getting into the strategy of where you're going to buy and sell. So ideally, just a quick overview, ideally, your goal is to buy as close to one of the lows as possible. And you want to ride it up closer towards the next high. Or if you believe that price is going to reach a major level, then you can create your strategy to where you're buying as low as possible and you're holding it as price rises closer and closer to that next level. So there's so many different ways that you can trade and so many different strategies out there. But the most basic strategy that I want you guys to learn is to identify when a bullish trend is starting and when a bearish trend is starting, and just identifying where those changes in the market take place. That is, to be able to identify that, you'll be able to incorporate that into your strategy when you're placing your trades. Overall, when I first got started, you have trend trading, you have counter trend trading. So trend trading is basically where you're buying into the lows of an uptrend. You've already identified that we have higher highs and higher lows. So you're buying into an uptrend. You're not taking sell orders at the tops, trying to call exactly where price changes direction. You're buying into the overall wave. You don't want to swim against the waves. I go to the beach almost every day now, and I can tell you 100%, when you start swimming against those waves, you find out just how small and insignificant you are in this world. And it's just not fun, right? You're going against the grain, and you have a less likelihood of being successful and winning. So you always want to trade with the overall trend. Find the waves, right? Find the waves. So if price is trending downward, and you can see that we have a change in direction, we have a lower low and a lower high. Now I'm looking for sell orders. I'm no longer looking for buy orders. So I want to find out, okay, if we created this low or we created a lower high here, we have a new low, boom. My whole objective is to sell at the most recent level. And this is the level. As you can see, we touched 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and then that last time 11. So we touched this line so many times, and you can see when price was coming up on this side, it had a hard time breaking through it. It took 4 times for price to actually close above this level. And then when price came back down, that then resistance level now becomes a support level. So now price is bouncing off of the same area. All right, and then we tried to push up, came back down. As you can see, it stopped here again before it finally broke back through. So once price breaks through a level, that level becomes weaker. But I personally like to keep my levels up just because it's important to know where price could potentially stop in the future. Some people will remove the level altogether once price breaks through it, and that's their prerogative. Me personally, I like to know where my major danger zones are. So if you're driving in traffic and you're going from one level or one destination to the next, you want to know where all the stop signs are. You want to know where all the street lights are. You want to know where all of your danger zones are that could potentially stop the momentum, right? So your objective is to ride that momentum and to trade with the wave. So as you can see here, when you're selling, you want to sell near the resistance levels. That's where you're looking to take your sell orders. When you're buying, if I were to put more levels here, like this would be a level, you could get away with putting a level here. And I can quickly see them now just because I've been doing it so long. But with practice, you'll be able to start identifying levels a lot more. If I can see we had a touch here, let me make this a little bit more clear. I know my chart's gonna start getting a little further. And if this is making sense to you, this is making sense to you and it's starting to click, go ahead and hit that like button and share this with a friend who may want to learn, the basics about day trading and how they can actually start making money in the markets. Like I said before, guys, you don't need a ton of money to do this. You just have to understand the fundamentals. You have to have proper risk management. And there's a lot of psychology behind it as well. But that part you'll start to learn with time. It's really just about having a level head. You don't get too high when you win and think you're invincible. You don't get too low when you lose because there's always another trade coming, right? So you can see this would be a level. I would consider this a level because we had some traffic here. It's okay if the candles go through your level. Like I said before, it's just the area. I just want to identify, okay, where is price touching multiple times? So if I'm looking to take buy orders, I'm looking to buy on that level, on the lowest possible level that I can. If price breaks through a level, boom, like here, price broke through this level, then it came back down here. This would have been where I'm looking to take my entries because I can put a stop loss right below that level and I can have a better risk to reward ratio. So your risk to reward ratio is basically the difference between how much money you're risking. So let's say here in this area, I only wanted to risk about $10. Let's say I got a $100 account. I only wanted to risk $10 here. And I have the potential to make, who knows, $50, $100, whatever. Let's say my risk to reward is 1 to 3. So for every $1 risk, I can make $3. So if I'm risking $1 here and I plan on getting out once I have about $3 or 3 times the amount I risk, that is a good setup. And we'll go a lot deeper into risk to reward ratios and all of that good stuff. But for now, I just want you to start training your mind to identify, where is this a trend? Are we consolidating? Basically, consolidating is this right here. This is consolidation, where price is bouncing between a range, but it's not really trending up or down. It's just kind of bouncing back and forth, back and forth. That's where you get all these ugly movements. It's always best, especially as a beginner trader, to wait for price to start to trend before you take positions. Consolidation will lose you a lot of money because you get a lot of false signals, and you'll know you're in consolidation because if you're doing your support and resistance levels right, you can easily identify that, okay, we're bouncing back and forth. We're bouncing back and forth, and then boom, price breaks through, and now we're starting to get some structure. Now we're starting to get those stairs, that staircase. So I hope this made sense to you. Rewatch this video over and over, put it into practice. Like I say, learners are earners. So if you are just consuming a lot of information, but you're not applying it, it won't do you any justice. I don't want to be the mentally rich librarian. I want to be the one that actually implemented the information in the books and actually went out and benefited from that information. All right, so go do something with this. If you want the notes, I'll be posting a link under the video where you can download the notes as well. And I hope you guys got a lot from this. I hope that you have an amazing trading career ahead of you if you choose to take this up. If you ask questions, join the community, and just grow. My whole objective with this channel is to help people learn the things that I wish I knew when I first got started and to cut out all the fluff. There's so much information online that does not actually benefit you as a trader. And I want to give you the information that's actually going to move the needle forward, right? Because anybody, anywhere can learn this. You don't have to have a degree. You don't have to spend as many years as I did trying to master it. Like I said, I've been doing it for almost a decade now. You can shorten that learning curve if you take the information that we give and you actually apply it. So I wish you the best in your trading journey. Definitely hit that subscribe button if you got value from this. I'll see you guys in the next one.